And our model is focused specifically for turnkey investors who want to maximize their investment return. So what we're going to be talking about today is not focused on people who want to go out and do their own investing that they have direct control over, manage every aspect of it, people who I consider real estate job owners as opposed to investors. This is really for people who have gotten to a stage in their life, whether it's through real estate investing or through their primary income earning vehicle, that are now ready to turn on the keys to a passive income stream and begin generating either monthly cash flow or long-term retirement cash flow. So first things first, important disclosures. This is informational only. It's not intended to be specific advice or a specific recommendation. Yada, yada, yada. My attorneys advised me to tell you that I could be completely wrong about everything I'm about to say. I will tell you it's come from over a decade of personal experience as a real estate investor, starting at 18 years old, and we'll go over that briefly, and growing a number of turnkey companies successfully into the multiple tens of millions in terms of annual investment dollars. But it doesn't mean I know everything, and there's certainly personal specifics that you always ultimately need to make sure that whatever investments you do are investments you understand, you're comfortable with, and are right for you. Never, never, never do it because someone else told you to. So quick overview, Direct Source Wealth is run by myself, Kira McClellan, and my husband. Our core team has a combined over 100 years experience in real estate investing game. And I've been an active investor since I was 18 years old. I started in single family, I've done multifamily, I've done mixed use, commercial residential, I've invested domestically in the US, overseas. If you're interested in my bio, it's on the website, but that's about all I'll say about that. Let's get into the meat of the matter. IRA funds. So you're on this webinar today because you either have funds in a self-directed IRA or you are thinking about putting funds in a self-directed IRA, and you would like to make a decision about whether to invest that in equity or debt, whether to invest that in real estate or stocks and bonds or joint ventures or any other type of vehicle. And specifically, we're going to look initially at some of the pros and cons of investing in equity versus debt within your IRA. So let's talk about equity first. While this webinar is going to focus on debt and alternative structures, I think it's important. A lot of people think about using their IRA, and there's been a lot of training and coaching around using your IRA to invest directly in real estate where you own the real estate. So you take your IRA funds, you put some money down, either through a turnkey program or on a property you purchase locally, and you fix up a property, rent it out, and keep that income under your IRA. So the primary benefit of that is leverage. You do have to do non-recourse lending because your IRA cannot sign for a personal guarantee, but you can leverage your money, meaning you have $50,000 in your IRA, you could buy a $100,000 property. You also have a little bit more control over the deal when you're an equity owner. But there's a lot of cons. The first one that a lot of turnkey companies don't discuss about IRAs owning real estate is possible exposure to what's called UBIT, or unrelated business income tax, meaning that the IRS could see you as a business owner in your IRA and therefore tax your IRA at a much higher rate. I think they tax it at the estate or trust tax level, which is somewhere around 40%. You'd want to verify that with a tax professional, but I do know that there is sizable exposure when you own real estate directly in your IRA, especially if you are very successful and you do multiple deals in a year, very likely to be subject to UBIT. You also, on the flip side, lose the tax benefits of being a real estate owner. So when you own a property outside of an IRA, you get depreciation, you get tax deductions for expenses. When it's owned in your IRA, you really get no benefit from those because they're already in a tax-sheltered account. So you give up a lot of tax benefit in addition to potentially having additional tax exposure. And of course, there is always, whenever you're an equity investor, there is equity risk, meaning, chances are if you did have some leverage on the deal, your principal is at risk before the lender is at risk, meaning that they could foreclose if something didn't go well on your deal and you could lose your equity and therefore your retirement accounts. So for security, for tax control, my preference is to use debt when I'm investing in my IRA or using my IRA. Having said that, I have owned real estate in my IRA. So again, to my point previously, there's no one-size-fits-all solution, but these general principles really do hold true, and more often than not, by a significant margin, I will be investing my IRA in debt instruments. The pros to doing that is, of course, the inverse of some of the cons of equity. There's no UBIT exposure. It's pretty well documented that you are completely, as long as you're a completely passive lender, meaning you're not controlling aspects of the lending business or underwriting the deals or running your lending business, but really completely passive, just lending your money and getting a return. There's good documentation to say that that is a passive non-business and therefore not exposed to UBIT. It is, as I mentioned, completely passive, so you can, if you're using IRA funds, chances are you're trying to build your wealth, so you're probably likely still working, and you need to be able to concentrate on what you're doing daily in your job while your IRA builds. Also, by investing in debt, you're secured against collateral. So unlike investing in the stock market, where you really are an equity owner in a business and have complete downside risk, meaning your investment can go to zero and you have nothing to show for it, with a debt instrument, you are lending against a hard asset, and it's collateralized so that if things really got terrible, kind of worst case scenario, you still have the ability to participate in a foreclosure on that property. In our case, a servicing agent would take care of that for us and foreclose on the property, and then we would either own the property or we'd be able to sell it to get back as much of our principal as possible. But being secured against hard assets is definitely an advantage over a lot of other IRA investments. Also, there's consistent cash flow. So, in most cases, you're going to be paid monthly. Some loans pay quarterly, annually, or on balloon. But you do have that consistent cash flow reinvesting in your IRA, and that stays under that tax-sheltered protection. Also, if you do ever need to access funds that are in your IRA, valuation is much easier when it's a debt instrument, especially if it's not in default. So it's much easier to get bought out, access your capital as a debt instrument than it is equity. With equity, you generally might need an appraisal or a BPO to determine value, and it can get very convoluted if you ended up in a worst case scenario and needed your cash back. The biggest con to debt investing is that generally there's no leverage available. So if you have $100,000, you're investing $100,000. You're not investing 150 or 200. But the returns are fairly sizable, and given the fact that it's tax sheltered, your net ROI oftentimes ends up about comparable to a leveraged equity investment on the equity side. So for all those reasons, we are focusing today on mastering those double-digit returns in your IRA by using debt instruments. There is also another combined solution that's sort of a quasi-equity, quasi-debt, which is mezzanine debt. Mezzanine debt is a financing vehicle that gives the lender the right to convert to ownership or equity if the loan is not paid back in time or in full. Or also, sometimes there's provisions that allow you to convert upon the maturity of the note. In general, this debt is a little less protected than a first lien loan. It'll generally be a subordinated debt, meaning that the owner can still go out and get maybe traditional bank financing or some other type of loan that's in first position. But but it has that equity conversion component in the end. So it ends up being a sort of a hybrid vehicle where you can get the best of both worlds. So generally, either a straight debt solution or a mezzanine debt solution is going to make the most sense, because you'll be able to, if you do want equity, you can convert at the end when there's a lot of less variables to your security. So let's talk about the benefits of real estate as collateral in terms of mastering those double-digit returns. If we compare to other vehicles like, let's say, a CD, which I don't have to tell you is not going to get you double-digit returns, CDs are laughably called in our business certificates of depreciation. That's not really what they stand for, but that's what happens. When you put money in a CD, you are not earning enough money to keep up with the rate of inflation in most scenarios. And so real estate, on the other hand, is generally inflation protected because the cost of living tends to go up with inflation. In fact, they're directly correlated in a lot of ways. So as the value or the cost of living goes up, the value of your collateral goes up and protects you, whether you're an equity owner or a lender. That does provide you some inflation protection compared to, let's say, a CD. The other thing, like we discussed earlier, is stocks, which don't, or even investing in venture capital, which I'm a fan of, with a small amount of your money in the right situation. But the risks of those is that they're not collateralized against hard assets, meaning you own a piece of paper that says you own, and I'll just speak from experience, it says you own $55 million worth of Enron stock, and then something breaks out in the news or something happens internally to the company, and overnight your $55 million becomes $100,000. And you have nothing really physical to show for it. I'm sure you could fly over to their offices and try to claim an old computer or a used office desk to say, hey, give me something of value for this worthless piece of paper. But it's unlikely that that's going to fly. Chances are you have complete downside risk, meaning your value could go to zero and you have nothing to show for it. Real estate, on the other hand, if you're a lender on real estate, you have a hard asset. If the person you're lending money to completely botches the project, you can always go in and take over the project. While that might not be ideal, it is certainly better than the comparison in the stock market. Ideally, you want to invest with an operator, a general partner that sees the project through completion, and we'll talk about track record later. But you do always want to consider your worst case scenario, and real estate as collateral in your IRA on a debt instrument is a hard asset and therefore much more secure. Also, there's commonly accepted valuation approaches. So if we compare to, let's say, venture capital and investing your IRA in a startup company, while there may be wildly high upside, 20 times your initial investment or more, there's really no clear-cut way to say what that asset is worth. So again, speaking from experience, I have some money in a technology startup, and when I go to apply for a loan, a mortgage or something, and I put down that I have 1,000 shares in Gigaband, which is a technology startup, how do I say what it's worth on a balance sheet? Is it worth $2 billion, $1 million, $200,000? There's really no commonly accepted valuation. On the other hand, if you make a note on real estate, you make a $100,000 note and it's paying 12% interest annually, and you've got monthly interest that's accruing or monthly payments that you're receiving, it's quite clear within a small margin what that note is worth, particularly if the payments are being made successfully. The note is most likely worth a minimum of $100,000 that you initially invested, perhaps even a slight premium. But there's not the wild swings in valuation that, let's say, the stock market or venture capital might have. And of course, another primary benefit of making a note, lending your money to get double-digit returns and having real estate as collateral, is there are long-term cash flow benefits. So when you're building an IRA account, you're not building it just to have a lot of money at 65 or 59 or whenever you choose to start taking your retirement distribution. You're doing it so that you have monthly cash flow. So if you build a portfolio now that creates monthly cash flow, when it comes time to leave your job and turn on that income stream, it's quite easy to do. You simply start receiving the distributions that had been going into your IRA previously. So you're building that long-term cash flow for yourself. Quick note on that, a lot of people don't know of a thing called a 72T distribution. A 72T distribution allows somebody to take cash withdrawals out of their IRA prior to turning 59 and a half and not paying taxes, or I'm sorry, not paying penalties. You still pay your income tax, not paying penalties on that distribution. I'm not going to go into it in a ton of detail here, but if you do have questions about a 72T, ask your RAC. They can either answer the question or get me on the phone and we can talk about that. And we can also help your custodian set that up. If you are interested in doing early retirement and didn't know that you could do that without paying a 10% penalty to the IRS. So having looked at the value of collateral of real estate in your IRA for double-digit returns, let's also look at how to protect your investment. Because it's not just the return on your investment, but the return of your principal that is of utmost importance to us when we invest. Number one, vet your provider before you fund. Proper due diligence is important. There are lots of double-digit return direct lending vehicles out there. They are not all created equal, and they are not regulated as closely as the stocks and bond security industry. So you have to make sure to do an extra layer of due diligence on your own. Going back to my point at the disclosures, you always want to make sure you understand the investment and you are comfortable with it and that you understand the risk you are taking. Make sure you're working with someone who has experience and that they can give you examples of what they did when a project went wrong. Projects do go wrong in this industry. If you go in thinking that this is like buying a CD and you have a guaranteed 12% and nothing will ever go wrong, then you have a misconception. Be prepared for things to go wrong, but work with a company who knows how to handle it appropriately. Sometimes when things go wrong, they actually go better than expected. What I mean by that is that I made a private note with an investment partner of ours in a property in Arizona. We lent $25,000 each for a $50,000 note on a property, and we had to foreclose. This means that things went wrong. We did not want to foreclose. We did not intend to foreclose. We just wanted our monthly payment, and we wanted our principal returned at the end. However, even though it went wrong, it went exceedingly profitably. We took over that property and we waited a couple years. We rented it out in the meantime for $800 a month of cash flow on $50,000, not a bad ROI. And at the end of a couple years, we turned around and we sold the property for $115,000. So that was quite a nice return in a couple of years, despite the fact that things went wrong. So how does that happen? Well, that comes from underwriting your deals appropriately and making sure you properly price in for risk. So we'll talk about that a little bit more when we get into the process that DSW uses for loan management and underwriting. At very least, you should be getting updates, I say every 2 weeks, really 2 weeks, twice a month, on a consistent basis with photos of the progress of the project, And with great providers, you might even be able to see through a security system, or even get out and go see the property personally. You do not necessarily need to lend where you can drive by every month. That's more of a personal comfort zone. But there are certainly ways through updates, through proper systems, to make sure that you can get eyes and ears on your investment without having to invest right around the corner in case there's better opportunities long distance. And that's what we focus on. So also learn the model that the company uses to evaluate the market. You don't have to know it inside and out, but have your real estate consultant explain to you how they're determining value, right? It's easy to throw up and say, oh, ARV is this, or the value of the property is that. You really want to understand what assumptions did they make to determine that value. While this is much more of a science than, let's say, stock investing in a startup venture capital, it is not black and white. And you want to understand the approach they use. And when you're talking with them, you'll also come to understand likely whether or not you're dealing with someone who's conservative in their analysis or very aggressive in their analysis. Ideally, you want to work with somebody who's conservative. Also, all projects should be handled through a title company or an escrow company so that you can verify funds at any time. You do not want to be sending your money out to Joe Blow's personal bank account. You want to be able to work through a title company or escrow company, and preferably, in my opinion, a national one, only because they're larger, they have more to risk if they do things wrong. So you want to be looking at, but there's reasons to work with small title companies too, but definitely you want a title company. Also, make sure that there is a good loan to value or loan to after repair value, so that what you loan, and at very minimum, what you loan is less than a reasonable assessment of the value of the property. You want to make sure that your loan has some wiggle room between what the property's worth and what's being lent on it. Or if you're a part of a loan that has multiple lenders, you want to make sure the total loan is less than the value. Check also, now I want to speak to actually a minute more. If you are investing in something like, we have a project in Dayton, Ohio that's a full gut rehab. So we're raising $8 million, but obviously the property isn't worth $8 million today. It's a distressed asset. But in that case, you can still make sure that the loan amount is less than what the value of the property will be when it is stabilized, and also make sure that the funds, again, are being managed and distributed through a title company as work is being complete, so that the funds get dispersed as the work gets done, so that the collateral's value is going up as the balance of the loan is being paid out. This is the way that you make sure that you're not over-lending on an asset that is distressed, like the one in Dayton, Ohio. And I love, and we do a lot of those kinds of distressed assets, and you'll find as a lender that that's part of why you're able to get these high returns. But you want to make sure that it's done in a way that's secure and still protecting you. And also also verify that there are checks and balances on the draws and distribution of funds, so that the funds don't just get released whenever the owner asks for it, but that there's an inspection process in place, that the work is looked at to be quality, and that the work that was said that was going to be done actually was done. So let's talk a little bit about how and why you get double-digit returns, because I get this question a lot. People will say, Kira, I'd love to make 12% in my IRA, but it just seems too good to be true. All my friends are making 6%, 5%, 4%. How is it you can pay 12%? There must be a ton of risk. And yes, there's some risk, but no, there's not a ton of risk in my assessment, and here's why. When you lend, you can still make sure you're lending your funds to a qualified borrower. All of the things we just talked about before. Somebody with a strong track record, a good game plan, who knows how to handle things when things go wrong, that there's good checks and balances with the title company. but they need to pay, I need to pay you 12% to borrow your money for two reasons. Number one, Bank of America, Wells Fargo, they're not going to make me a loan on an asset that needs a huge rehab. That's just not what banks are in the business of doing. They like to lend. They might do it once in a blue moon, but in general, they like to lend on the stabilized asset when it's complete. That's their business model. And because they lend on the stabilized complete asset, their interest rates are like 3 and 4%. That's all they make because they only take on the stabilized project. You get the opportunity to come in and make those double-digit returns because you're funding the actual construction and rehab, and the bank will take the loan from you at the end when we refinance. This does not mean that the distressed asset is a terrible, high risk asset. It just means that it's not the bank's business model to lend. But you can still verify that the people you're lending to, like I said, have a good track record like we do, and have high integrity and good credit and never had a foreclosure, and of course that you have the property as collateral. The second reason why you have an opportunity to make this loan but that some other people don't do it, is because of a general kind of fear factor. People tend to think if I'm finding it, or if it's legitimate, everyone would be doing it. If I can find it, everyone would be doing it. But the reality is that this particular kind of niche of investing has generally been reserved for large hard money funds that are backed by large insurance companies, or ultra high net worth individuals. And only in the last few years, through the creation of the Jobs Act, has it become feasible for individual investors, smaller individual investors than large multimillionaires and hedge funds, to be able to participate in these kinds of investment opportunities. So let's talk a little bit about how you continue to talk about how you protect yourself and minimize risk, and continue to make those double-digit 12% returns. Number one, it's all about the systems. So at DSW, we have turnkey investing systems. We have multiple departments that search for deals, vet the deals, negotiate the deals, manage the construction bidding, do the rehab, stabilize the asset, find the refinancing. By having that in a systematic process, we've removed a major level of risk for you as a lender. One of the biggest risks that a lender has is that the person driving the project, something happens to them. They get hit by a bus, sat on by an elephant. Who knows? But they can't keep doing their work, and the project falls apart. When you work with DSW, you have a large system of support in place so that if one particular person, myself or my husband, or even your personal real estate consultant you're working with, if something happened to one of us, things would not go on halt because the project managers exist. There's redundancy and overlap within the positions of the company, and this drives forward continued success on the actual rehab, so that you don't have to worry about it going into foreclosure and dealing with all those types of issues. So on the lending side, escrow plus inspection and a strong LTV, or loan to ARV, after repair value, equals success for you as the master of double-digit returns. Let's talk a moment about escrow. At DSW, we use Chicago Title as our national escrow company. We might, from time to time, have to use another one if a particular state's law prohibit Chicago Title from being able to handle the transaction, or if there's another party in the project that brings a lot of value. But in general, we use Chicago Title. You will wire your funds to Chicago Title. They will send you updated title and lien reports on a regular basis to make sure that there have been no liens filed by any of the contractors throughout the process. And they will provide the funds and draw reports to investors. So they'll provide the funds to the project and draw reports to the investors, letting you know on a regular basis the status of the collateral, the work that's been done, versus the balance of the draw on the loan, to make sure that that's always kept in a healthy balance. Also, they will distribute funds only when lien waivers and inspection are completed on each phase. So you can rest at night comfortably knowing that a large national company is keeping an eye on your loan and that funds are not being released until appropriate measures are followed. The inspection process is also critical. That's the part that actually makes sure on the ground in the field that the work that we said we would do was done and was done well. So that is a monthly site visit that is tied to the draw. So the inspector goes out a few days before we request the draw and looks at photos, creates photos for you guys to see, verifies the work that was done per what's called the schedule of values, which is the phases of work that'll be completed on the project. They collect the sub-lien release waivers to make sure that everyone's been paid, no one's going to come back later and try to file a lien on the property. And they inspect the work and make sure it was done to the defined scope of work. Then they authorize Chicago Title to release the monthly draw payments, and Chicago Title goes through the escrow process we discussed previously. The last step in protecting your double-digit returns and being a true master of double-digit returns, meaning that you consistently get double-digit returns and you're not dealing with the headaches and foreclosures and concerns that other investors may have to deal with who don't have this strength of due diligence behind them. The other step of being a master is making sure you have a strong loan-to-value or loan-to-after-repair value. So you want to look at, on commercial real estate, you want to look at the market cap rate. And I can always provide a report of regional, recently sold projects of comparable size, and you can see what the market cap rate is on a stabilized asset. It's usually a range. As I said, it's not a perfect black and white science, but it is a pretty clearly defined range. In this case of the Dayton project I discussed earlier, it's 6 to 8%. Then you compare that to the target property rate. So what does the pro forma say based on reasonable rent assumptions that the cash that will be created by this project when it's stabilized? And that gives you a value on the stabilized property. And you want to be at an LTV of 80% or better to the after repair value. So if the after repair value is going to be $10 million, you don't want to have more than $8 million lent on that property. Maybe 7, 6, 5 million could even potentially be better. But if you have that 20% margin, you're likely to be okay. Even in the worst real estate market in history in the last few decades, the market fell 20 to 30%. So a 20% margin is still likely to protect you. But as I said, LTV or AR fee protects you as a lender because in case of a default, there is equity available in the deal to protect a strong return on investment. Regardless, though, there is no perfect solution, right? It's still possible that you could lose money in a deal, but with all of these protections in place, you can see why we have never had a foreclosure in our portfolio. And while you can lose money in private note investing, you can also lose money in all the other investments that you've been looking at. Stocks, direct investment in private placements, technology startups, even a CD loses purchasing power because of the depreciation. So I want to just briefly mention that before we get into Q&A, I've used the term REC a couple times. Many of you on this webinar already work with us. You know the terminology of a real estate consultant. But for those of you who are new, part of our systems and process is making sure that you have a single individual in our company who gets to know you, your goals, your values, who will help you become a master. They're sort of your sensei of real estate investing and private note investing, if you will. They're going to work with you directly to make sure we understand your goals and objectives and help you build a strategy, identify properties. They're going to be the one out in the trenches for you when a good deal comes up. Our deals fund very, very quickly. They're going to be the one making sure that they reach out to you and say, hey, before this goes out on the internet, before this gets broadcasted out to the world of investors, let me tell you about what's coming up next week. And they're going to protect you, make sure you've got the best access to deals that are coming up. So obviously, if you already have a rec, make sure you're talking to them. Make sure you're letting them know if you have funds coming due or cash coming available. They're not going to know unless you tell them, and they're not going to know to look out for a deal for you unless you let them know. And if you don't yet have a real estate consultant, please, our number's up there on the screen. Give us a call today, and we will connect you with a real estate consultant to help you start mastering your double-digit returns today. That number is 720-445-4546. If you have any questions, now is the time. I'm going to open up the chat and the mics so that you can ask whatever questions you have. Thank you for listening. We look forward to helping you grow your wealth and co-investing with you to create long-term intergenerational wealth through direct source wealth. So if you have a question, click on the hand, raise your hand, and I'll unmute your mic in particular. So Jason just typed in a question asking what the phone number again was. So I'm going to give that real quick. It's 720. Well, actually, I'll give you a second to get a pen and paper. All right, you ready, Jason? It's 720-445-4546. And I do see the typed in comments. I really appreciate that. Eugene, thank you. I'm glad it was helpful. And Dave, I'm glad you enjoyed it. Any other questions? Oh, I've got another hand here real quick. Let's see. Oh, wonderful question. What is the best way to get started? Love it. So definitely call us, get connected with a rec, and they will be able to help you identify deals that let you know what's happening. Our website, while I love having our website, is not the most up-to-date. As I said, our deals fund very quickly, so giving us a call at that number will get you connected with a rec. The other alternative is you can email me personally, and I will get you connected with a fabulous real estate consultant. So my email is my first name, Kira, K-I-R-A, at the name of the company, directsourcewealth.com. And we can help you identify the right deal to get you started in, and most importantly, develop a strategy over the course of a year, 2 years, 5 years to get you to your goals. So you're not just throwing money here left and right, hoping you're doing the right thing. We'll help you actually build something that's going to build that long-term cash flow. Thank you. That's a great question. Any other questions? All right, I did get a question about somebody who went on our website. They were asking about the Puerto Rico deals in particular. We do have another webinar coming out on that, so stay tuned. You're welcome to come participate. We'll talk about in more detail. But there definitely are, in addition to, I'll just mention this briefly, IRAs are a great way to invest in notes, but there are other vehicles that can create massive tax savings. And one of those is some of the opportunities that are happening in terms of being a registered corporation down in Puerto Rico. So again, stay tuned for that webinar coming up in the next few weeks. That you can set up entities as well and do lending out of your Puerto Rico entity with your non-retirement funds and also receive cash benefits there. All right, we are out of time. I thank you all so much for participating. I wish, it's so strange, I can't even tell you how weird it is talking to a computer screen, but I do feel like when we get to the Q&A portion, I get to know you guys a little bit. So thanks for asking questions, and I look forward when you do call in or email, please let us know you are on this webinar, and I love to make that connection. For us, this is a deeply personal business, and it's interesting trying to create that personal connection on a webinar, but we look forward to talking with you in person and working with you and your family for years to come. Thank you again, and have a fantastic weekend. Talk to you soon. Bye-bye.